Today, we're examining the renewed debate around U.S. stock market valuation in 2025, with a particular focus on the S&P 500. This discussion is intensified across professional research desks and public forums alike, in part because several valuation gauges have climbed well above their long-run norms, while market performance has grown increasingly dependent on a small cluster of very large companies. Our goal here is to lay out the facts, the historical parallels, and the risks being discussed, and the counterarguments, clearly and without advocacy. In market terms, overvaluation is the condition in which prices appear higher relative to fundamentals such as earnings, revenue, or long-term economic capacity. One common lens is the forward price-to-earnings ratio. By mid-2025, the S&P 500's forward PE hovered around 22 times expected earnings, notably above roughly 16 times median over the past 2 decades. Comparable figures show the NASDAQ 100 around 27 times and the Russell 2000 near 24, signaling that premium pricing is not confined to a single corner of the market. Another reference point is the cyclical adjusted PE, known as the Shiller Cape. It smooths profits across a full cycle to reduce the noise of booms and bursts. By the summer of 2025, CAPE readings were near their second highest historical levels, approaching peaks associated with the early 2000s technology bubble. A broader macro gauge, the so-called Buffett indicator, total U.S. market capitalization relative to gross domestic product, continues to sit well above long-term averages. This suggests that equity values are elevated when mapped against the size of the economy. Now, valuation is only part of the story. The structure of the rally really matters as well. In market concentration, which is the share of index value carried by its largest constituents, has been climbing, and as of August 2025, estimates place the top 10 stocks at roughly 36 to 40% of the S&P 500's market capitalization, a record in modern index history, a cohort often referred to the Magnificent Seven, which is Nvidia, Microsoft, Apple, Amazon, Alphabet, which is Google, Meta, and Tesla. Collectively, they account for about 35% of the index total value. Meanwhile, the top 10% of individual U.S. stocks encompass approximately 75 to 76% of the entire equity market by capitalization, a level that surpasses concentration observed at the height of the dot-com cycles and rivals conditions last seen prior to the Great Depression. The largest single company, frequently Nvidia or Microsoft, during 2025 has at points been on the order of 700 to 800 times the market cap of the 75th percentile stock, a dispersion that's not widely seen since the 1930s. These are structural facts rather than judgments, and they matter because heightened concentration can magnify index level sensitivity to idiosyncratic news in a handful of firms. Now, performance numbers illustrate the divergence. Through July 2025, the S&P 500 was up roughly 7.75% year to date. Yet, the equal weighted version of the same index, where each stock counts the same, trailed by about 1.5 to 2 percentage points. The message is straightforward. Gains remain disproportionately driven by the largest companies. Nvidia's extraordinary rally of roughly 171% in 2024 became a symbol of that dynamic. And in 2025, leadership had been more rotational and at times less one-sided, but the weight of big technology and AI-adjacent firms remained decisive. Any assessment that uses the word overvaluation inevitably invites historical comparison. The pre-1929 era and the early 2000s are common benchmarks. Before the Great Depression, measures of concentration rose to about 75% for the top decile of stocks similar to today's magnitude. And dispersion between the largest and median-sized firms reached extreme ratios. That period ended with a dramatic market drawdown. In 2000, the top 10 names controlled roughly 27 to 36% of the S&P 500's value, and on the broader top decile, concentration stood nearly 73%, also followed by severe correction in technology shares. There are, however, material differences between then and now. Many of today's index leaders produce substantial earnings, and cash flow, often with dominant competitive positions in software, cloud, semiconductors, digital advertising, and consumer platforms. The AI investment cycle, which includes capital expenditures in data centers, chips, and model deployment, gives proponents a tangible profit narrative that did not exist for many dot-com companies in 2000. The late 1960s and early 1970s Nifty 50 episode provides a third lens. A compact set of highly admired companies commanded premium multiples for years before challenging inflationary decade compressed valuations. The relevance of each parallel depends on which underlying driver, profit rates, or sentiment you believe is dominant today. Beyond snapshots of multiples and concentration, professional debate often turns to the equity risk premium, the extra return investors demand for holding stocks over treasuries. With policy rates higher than most of the last 15 years, comparison between earnings yield and bond yields have narrowed, making valuation premiums more conspicuous. Advocates for caution argue that when the compensation for equity risk thins while concentration rises, the market's margin for error tightens. Others counter that even if productivity accelerates, especially through AI-enabled efficiency, and if earnings growth compounds at a faster clip than currently modeled, elevated multiples can be worked down over time without the need for major price correction. But market structure also matters. The rise of passive investing means inflows to broad index funds disproportionately allocate the largest names, reinforcing their size and influence. This feedback mechanisms can be benign in stable conditions, but it may exaggerate both upside and downside in response to news about future index leaders. Breadth indicators measure of how many stocks participate in advances have alternated between strong and narrow in 2025, with small cap shares at times lagging despite more attractive headline valuation metrics. That divergence is a focal point for managers who believe an eventual rotation toward under-owned or cyclically sensitive areas could rebalance risk, and for others who worry that persistent narrow leadership leaves the benchmark vulnerable. Macro forces are the final layer. Growth, inflation, and policy set the backdrop in which valuations are interpreted. A soft landing scenario, slowing inflation without deep contraction, to support higher multiples, particularly for durable cash-rich businesses. Conversely, a reacceleration of inflation, a profit recession, or a policy mistake could challenge prevailing valuations. It also is relevant that the S&P 500 has at times this year traded roughly 60% above its long-term exponential trend dating to the 19th century. Another way analysts frame the notion that prices have pulled forward a considerable amount of good news. Notably, the index endured a correction of about 10% early in 2025 and then rebounded to set new highs by mid-year, underscoring that elevated markets do not move in straight lines even when the longer-term trend remains constructive. The principal risks cited by valuation skeptics are reasonable. First, earnings disappointment at any of the mega caps could transmit quickly to the headline indexes. Second, a narrowing equity risk premium at a higher rate could compress multiples, even if profits hold up. Third, the mechanical flows of passive investing could become a headwind in a downturn at the same concentration dynamics unwind in reverse. And in fourth, historically extreme dispersion between the largest company and the median-sized firm may indicate fragility if leadership falters. These are scenario frames rather than predictions. The counter-arguments emphasize resilience and reinvestment. Supporters of current valuations point to robust balance sheets, high returns on invested capital, and secular growth drivers in AI, cloud infrastructure, and software productivity gains. They note that unlike in 2000, many leaders today generate substantial free cash flow and return capital via buybacks. while funding expansion from operational strength rather than speculative financing. And in this view, premium multiples reflect durable earnings power and strategic dominance, not a pure sentiment premium. So where does that leave investors? Facts are that valuations are elevated versus long-term medians, market leadership remains unusually concentrated, and historical episodes with similar features have often resolved with either powerful earnings catch-up or valuation reset. The path that ultimately plays out will depend on profit trajectories, cost of capital, and whether productivity tailwinds from new technologies materialize at the scale now implied. As always, the perspective is essential. Risk is not a verdict, and resilience is not a guarantee. Before we go, a quick family-friendly note. The market's gotten so top-heavy that if it was a Jenga tower, we would all be whispering, "Please don't let NVIDIA squeeze." What do you think? Are current valuations a sign of excess or a reflection of a new earnings era? Share your perspective, your evidence, and your expectations for the next 12 months. And wherever you are tonight, remember that progress is often the sum of small, steady steps. And clarity comes when you pair curiosity with discipline. Keep learning, keep moving, and keep your head when the world gets loud. May God bless the world and your family as well.